Okay. Good morning, everyone. Hopefully we're live and everything's set up correctly here. Different setup today. Looks like there's a few people. Yeah, the room might look similar. It's actually very similar. I had to do this sudden room change. Something to do with this unit is next to the other unit, which had some type of gas leak. So my landlord wanted their unit empty or something. So they actually have one right next door. So I moved next door. It's almost identical. It's actually kind of spooky walking into it, where you're leaving one and you're going into one that's nearly identical to the other one. It was kind of a weird vibe going there. But yeah, I did the best I could here, and we're good to go. So yeah, the only difference is this microphone. It's in a different spot. So the room that I moved from to the room I moved to is incredibly similar. And I actually even commented to her that she's actually very similar to my brain, where I would do that. I would just go buy. She has 4 units that she Airbnbs out, and that's exactly what I would do. I would just buy the exact same furniture, the same cushions, pictures, 4 times. It's just my personality, my analytical brain. Vanessa would be in the store. She wants to have a theme. Every room would have a different color and different themes, and she'd be in there shopping forever. My brain would just say, let's just buy 4 of everything and let's go home. So yeah, the only difference though is the shape of the table, which unfortunately makes the microphone a little bit weird. And so hopefully the sound is good. And I think it's the right distance. It's just a weird angle, and it's tilted, upside down, and kind of freaking me out because I'm such a newbie to this live stream stuff. But and then the other thing to just be aware of, I have noticed that just the camera sees something in this room that's a little bit different, and the autofocus has been pulsing a little bit. So if I go in and out of focus, well, hopefully you can at least hear me. So, all right, hectic morning. I feel like my heart's beating here. I got to calm down a little bit. I see one really good question in the comments, so I'll get to that one first. I do like to wait a couple minutes just for everybody to roll in. But that's a good one. We'll start with that. The situation with the VXX Put that we're holding. One of the best times to talk about stuff like that is when something's not going well. So yeah, we'll start with that one. All right, yeah, I can't get in the right position. This is such an odd table. First of all, it's glass, so I feel like I don't want to lean on it. I kind of want to just lean forward and do my stream, but I'm leaning on the corner piece of glass here, so not a great choice for a table. I don't know, not like I'm going to mention it to this girl, but you probably shouldn't buy glass furniture in an Airbnb rental. I think that's a little bit of an oversight. I can hear the people in the unit next to me, parties late at night, and this is Vancouver, so legal drug use, and you can imagine you'd probably want to buy a real basic, stable wooden block as the kitchen table. But she's got this super fragile glass. It looks great, but would not have been my choice. So hopefully midstream I don't fall through this thing. All right. So we got a few people. Let's start with this question from Vibrant Cosmos, because it's a good one. We're in a little bit of trouble with one of our trades. Not trouble, it's expected, but let's go over what the situation is. So he says, good morning. In the leveraged portfolio, I am still holding VXX 1350 puts sold. So that's the vol trend strategy within VTS options. We sold the 1350 puts. I believe it was on March 9th. That date rings a bell. And it's as a loss as of now. Was there any update on VXX puts? Is there a stop loss trigger for getting out of them? So first part, no, there is no updates. We are still in that trade. It's officially on. And there is no stop loss for this strategy either. So there's quite a bit built into this question, which I like. There's a lot I can talk about here. And so I'm just going to kind of go on a ramble about this specific trade, some thoughts that pop into my head, and hopefully in a roundabout way, I get to a few answers for you. So let me go to this screen share, and we'll just look at the trade we're talking about. So it's this 1350 put. Don't look at the contract size. The official contract size should be 25 puts in the official portfolio. I typically sometimes take extra trades, but it's currently, we sold it for 16 officially. I think 17 officially, but I sold it here for 16. And it's at 94. And that's because the VXX has just crashed an insane amount in the last week since we opened it. So from a sort of a broad portfolio perspective, this is a really good sign, right? All of the strategies are performing extremely well right now because of this crash in volatility, because the stock market is going up so much. Since we opened these trades down here, of course, what was it? Vibrant Cosmos is in the leveraged total portfolio, which means things like the MVV, for example, these are up pretty substantially since we got into them. The SSO is up. The QLD, of course, is still, it had a rough day, but it's still pretty significantly up. And of course, the tactical volatility strategy and the aggressive vol, they're both up substantially because they are direct volatility strategies. So whenever we see something like this, typically for our portfolio and the way that it's set up, this is what we want to see. I mean, I try to trade the market that's in front of me all the time, and I try to have a solution for every problem that's in front of me. But if I could choose the market, I would choose one of two, and I'm sort of indifferent to either. A strong trending market upward or a strong trending market downward. If it was, financial crisis 2008, I would be very happy with that. I'd be making a lot of money and everything would be fine. Strong trending market upwards where the S&P is doing very well. Same thing. Very pleased. The portfolio would be doing very well in those conditions. And of course, I'd choose one of those two. Hard to say which one would be more profitable because while the financial crisis style sort of 6 to 12 month recession, that is a trend. It's just a trend down. Those can be extremely profitable, but more choppy. So those have potential to make more, but the strong uptrending market is probably the most stable one that just everybody's comfortable. You breathe a sigh of relief. Every day you wake up, the market's up. So all good. However, when you're dealing with a strategy that is selling short put options on something that has crashed, right? We sold it on this day. We sold a 1350 when it was at, I believe, about 1470. So it's gone from 1470 down to 1285 in the time that we are holding this position, which means it is down. So we will highlight that trade. Excuse me. I'm going to just use my calculator here and run some quick numbers for you. Our break-even point is officially 1333. So if you take 1333 minus today's price of 1285, it's right now, if it ended today, if the next 3 days were flat, this trade would lose 48 cents on a contract size of 1,350. That's 3.5%, basically 3.6% down. So that's why this question is being asked. Is there stop losses? Is there something we should be doing? Because this trade is down actually quite a bit. For an individual weekly trade, losing 3 to 4% is obviously in the somewhat extreme range where you really don't see crush like this very often, especially 6 days into it. Very often you see vol crush after a spike, but it's quite rare that it sort of mid-cycle accelerates down. Let me just expand so you know what I'm talking about. When you get a VIX spike, it's pretty normal to get sort of like a bottoming, but these flushes down are what's going to crush the vol crush strategy. So this initial wave, this is fine. It's predictable. This is actually totally fine. But occasionally you get something like this one. Hopefully you can see my cursor. That would have been, definitely a pretty large problem. Losing week, maybe 3 to 4%. And this again, this is predictable, this first bit, but then you get a flush out and you find yourself down money. So what does this all mean? Well, strategy specific, like I said, it's down nearly 4% now. Let's say 4. It's 3.6, but it's basically 4. The previous trade from last week made about 1%. So The vol trend strategy currently, if the month ended, would be down about 3%. On its own, losing month. But you have to remember that the only time this strategy can ever actually get into trouble is when the other 80% of the portfolio is doing very well. So if you looked at it on an individual basis, it might be time to start looking for either the exit to get out of the trade, maybe looking to fix the trade, maybe adjust something. It's clearly not working. It's going in the wrong direction. But given the fact that it has 80% of the portfolio hedging it, basically, and the broad portfolio still, despite the 3.5% loss, is still doing very well, there's really nothing to do. I mentioned this in the last stream. Somebody asked me what the maximum drawdown is. It's roughly about 18% for that strategy. I could get the exact number. That spreadsheet's kind of frozen, so I don't want to load it now, but let's say 18%. When would that happen? When would we suffer an 18% drawdown in the vol trend strategy? That would only be under extreme conditions where the market is doing very well, volatility is crushing. The vol trend would be down 18% in a drawdown, but the rest of the portfolio was up way more than what the vol trend lost. So that's kind of the difference here. If you looked at it sort of in a vacuum on its own, you might want to start looking to do some things with it, but it's not. It's the only strategy among the 5 that I trade, right? Everyone has currently right now, it varies, but 5 20% allocations. None of the other 4, tactical balance, defensive rotation, none of them get signals from the other strategies. They are totally independent. Nothing I do in defensive rotation has anything to do with what I do in VB threshold. They are totally by themselves. Vol trend's not like that. It is absolutely looking at the positions we are in with the rest of the portfolio, and it will only get aggressive when the rest of the portfolio is very strongly net long the market. If we were in a financial crisis type situation where 80% of the portfolio would be fine, we'd be probably doing quite well and be happy with that, vol trend might not actually trade in that situation because now the portfolio is net short the market, and you can't be shorting puts because now you're subject to the full brunt of any vol crush that you see. The way that I've structured vol trend, playing off of the rest of the portfolio, it's actually not risky at all, even though on an individual strategy basis, there will be times when it's uncomfortable, when you're thinking, wow, the VXX just keeps going down. But you got to understand that it does, but this trade right below it, let me just do a quick calculation here. This is the tactical volatility trade, 20% allocation to the portfolio, 683 minus 575 divided by 575. So the option itself, this trade is up 19%, 18.8. And it has about a multiplier, I think, of 0.39. The multiplier meaning, remember, we are reserving capital. We're taking lower delta trades. So it's actually only feeling about 0.4% of the actual move. But tactical volatility is still up over 7% right now. So 20% of the portfolio is up 20%. 20% of this portfolio is down 3.5% because of this vol trend that's going poorly. And then the other 3, of course, are up substantially. So as a whole, again, there's only one of our strategies where you don't want to really nail down, well, all of it, you want to look at the broad picture always. What is the total portfolio doing? But vol trend is only losing money because of how good the other ones are doing. I guess that's the only way I can really say it. And so that's why there won't be any stop loss. It doesn't mean I won't end the trade early in the week. Sometimes I do. Sometimes I just roll it out to next week. If I do roll it out, I now have a green light to get even more aggressive with it. That's one of those situations where you think, well, maybe you want to stop loss out. Maybe you want to reduce risk. Actually, the right move right here, if we look at it, because if this continues, if vol crush keeps going, and of course it can, it always can. Next week, the VXX could be down another 10%. But again, the broad portfolio would be there to protect it, and it would still be a large net gain for the week. But what the play would actually be is to get a little bit more aggressive. So this is next week's string. I could start looking at something as aggressive as the 1250s or the 12s. You can see the premiums, 22 to 23 cents, 47 to 48. Something in between there might be really the sweet spot, something around 30 cents. Because when this happens, the likelihood that it happens 2 weeks in a row is obviously diminished. And even if it did, 80% of the portfolio is still going to fully hedge this. So my play, instead of managing things and stop lossing out, and my play is actually just to re-up for next week. Now, whether I do that tomorrow or wait till Friday, I don't yet know. I'll have to see where those premiums land. Right now, we're sort of in that in-between where I'd like about 30 cents and there's only 20 or 40 available. So I might wait a day or two. But that would be the play to look forward to, is that there will probably be a follow-up at some point, maybe on Friday. Typically, I'll just wait till Friday. But yeah, we can go ahead and do the same trade next week. And while that one could also lose and our 4% drawdown could turn into 8, the rest of the portfolio would not care at all, because boy, if this 4% went to 8 and then 12 and then to eventually 18, like I've historically seen, the total portfolio solution would have made a ton of money during that period. The leveraged portfolio would have been up so much more than the losses, nobody would really even bat an eye. Now, the strategies are designed so that they can all make money at the same time. This is not a direct mathematical inverse. If vol trend makes money, tactical vol can also make money. It's not a situation where one has to win and lose. It's just that this move is happening so violently, this vol crush so quickly in the VXX, that actually the vol trend is losing. It takes quite a bit to surpass that premium that we sell. You have to have vol crush, above and beyond a normal level to even be considered the loss range. So to be down, 60, 50 cents on a trade that we only opened it for 16, that's representing that this is actually quite significant vol crush. We don't actually see this very often. But of course, I'm welcoming more vol crush. The broad portfolio is all I look at. I don't want to be a trader who says that no individual strategy ever did X, right? I don't care about the individual results. I just care about the total portfolio continuing to move upwards. And the more vol crush, the better, despite the fact that that would be bad for one of the strategies we trade. Certainly it would not. It would be a net win by in a large percent. So not worried yet. No stop losses. Like I said, hopefully I accidentally stumbled upon an answer to that question. Second part of the question, or different question. Today we moved SSO to SVXY. Is it because contango is too high and that's factored in? It's not because contango is too high. It's just because we have now moved into a fairly low volatility level. And on a long-term time horizon, when the volatility barometer is between 20 and 40%, and of course, plus or minus, nothing in the markets is step over this line and everything changes. There's variations in between. So let's say 15 to 45 or 50. My stream quality was reduced on me. Anyway, 15 to 50-ish, the SVXY actually still outperforms the SSO. So while the SVXY is now only a 0.5 leverage factor, it still outperforms the 2 times S&P 500. So now SVXY is an even more aggressive position than the SSO is. And that's because volatility has dipped quite low. We are witnessing some significant crush here. And now is the time to sort of be net long the market. And, it sounds bad when you say it, but basically hope that this continues. Obviously, like I said, I always have an answer and a solution for all problems, but that doesn't mean I don't have preferences. And I would prefer that we finally do get one of those sort of month or two stretch where everything's kind of boring and calm, and we see the VIX come from the mid to high 20s for the last 6-8 months down to something, in the mid-teens-ish. So would be nice to see. That would be my preference. And if that's the case, then SVXY is the better position than the SSO. Okay, this is a kind of follow-up. With VXX dropping so quickly, much quicker than roll yield, do you have any comments on what's going on? I would say no. It's just been what I've been talking about for months. I've probably mentioned it a dozen times now in different streams that volatility is way too high. It needs to come down at some point. There's going to be a period where we see significant vol crush. It has to happen. You can't have a market that is just sustaining this consistent upward trend and then have, the VIX index not do some of these things. So of course the vol trend is fully priced in. I knew that this was coming. I've positioned my portfolio correctly for it to come, knock on wood / glass table here. If this continues, we have got whipsawed a few times, but if this continues, it would actually be completely normal. The abnormal is the fact that the VIX was bouncing around between 20 and 35 while the S&P 500 is knocking on all-time highs. That was actually the abnormal part. The completely normal part is what we're seeing right now. So again, it just so happens that specific strategy is fine-tuned. You could make a case that sort of this is a quasi-market crash. This is a sort of mini volpocalypse from the perspective of the vol trend strategy. The worst possible outcome for that individual strategy is extreme vol crush. That's the only way it can really lose money. So while the rest of the portfolio is thinking, wow, this is awesome, we're at all-time highs and everything's great, the vol trend is experiencing a little bit of a crisis. And I like that. I know that some of you might be a little uncomfortable with that, it's such a shame that this one's down when all four of those are doing so well. That's actually by design. I specifically fine-tune my portfolio to be able to do that. So what I'm witnessing this week is actually making me quite happy with the portfolio and how it's performing. I like the fact that we've got that one strategy now at a full 20% allocation that can sort of feed off of the success or failure of the previous four. When I finally do my presentation and introduce all of this fully to everybody, I will show you the trades that I've been taking this year. And remember, January was a losing month for us. The total portfolio lost 4.6%, and the leveraged total portfolio lost 5.5% just in January. The vol trend strategy was up money. It's up 5%. And so depending on how you use that balancing the rest of the portfolio, it is possible that the losses are significantly less. That is only possible if the flip side is also true, that when everything is all good on one side, well, maybe not all good on the other side. So I love inverse correlations, especially when both of them can make money. Hedging is a terrible thing, and it bleeds capital long term because it's a mathematical impossibility that both of them make money. That is not the case here. Vol trend can definitely profit with the broad portfolio. So just give it some time to sort of sink in and watch your portfolio grow as vol trend is declining, and it will sort of sink in. I see what's going on here. So no problem yet. To use options instead of SVXY in today's threshold, would it be correct to buy the June 17 for 1,300? I didn't update the instructions, but what I have been doing lately is in the aggressive vol strategy, I have actually started including trade instructions for if people want to use options instead of SVXY. So let's get this slow internet going. In my streams, I used to load all these pages ahead of time, but I've had some cancellation or some crashes. So now I'm going to unfortunately have to open these things live. Might slow us down a little bit, but the stream integrity might be better that way. So apologies for that, but we're going to go down to the aggressive vol here. And right here I said that if you wanted to do options instead, you could do stock replacement. And the replacement that I chose, because this was opened, last week, was the long June 20 puts. And of course I can't change this because some people were actually in it. I don't want to change it every day and then everybody's in a different position. It's like tactical vol. This is the position we're in. Oh, I can't highlight that. This right here is the position we're in, and that doesn't change until we switch positions. So the one that you would want to get into is this one. You'd be looking for that VXX 20 put out in June, and it wouldn't be one contract per 1,500 if you're opening it today. It would be one contract per 1,300, right? Because the VXX has come down a little bit. But I would still stick with that contract all the way out in June. That 20 put, it's still a good one. It's still a delta of 5.57. This is still one that I would choose. You can see there's, whenever you see sort of like large open interest, not to toot our own horn too much here, but that's a lot of the volume on long-term VXX put options is VTS people. So whenever we do a trade, sometimes we see really big volumes there. But that's what I would do. I would do this. And then same thing applies, just to extend it further. If you wanted to do this instead, then you just use the same instructions. Now, if you happen to be somebody that's already in this one and you want to do the same thing as well for here, then yes, you could choose a different strike. Tactical vol is in the 18. Aggressive vol is in the 20. Very little difference between those two positions other than just to keep it logistically simple for people. And then the third one, choose the 19, the 17. Just choose something else. Just to keep things clear in your own spreadsheet. But yes, you can always replace with options. No problem at all. And I have started to give those instructions, so it should be pretty clear. Okay, stock replacement. Let's say a person wants to replicate a position in MDY using stock replacement, has limited capital for the position, just around 6,500. Probably not possible. I don't know what's with my voice. Something about live streams. IWR, 27 billion. Let me just check to see what you're talking about. IWR, the Russell mid cap. Just want to check some correlations really quick here. IWR is that Russell mid cap ETF. I'm checking because I'm actually not familiar with this thing. MDY. Okay, so, I mean, performance-wise, it's close enough. Size-wise, it's close enough. And one more check. I'm just going to check how liquid the options are. Not great. No, it's a no-go. So what he's getting at has, you already, I should have just read ahead. Has 96% 6-month correlation and costs only $75 per share. So the $75 per share is important for stock replacement because one option contract equals 100 shares of the underlying. So when you're dealing with something like the MDY, which is a very high-priced ETF, 100 shares of MDY is actually a substantial amount of capital. So when you're doing stock replacement, especially if you're on a smaller account, it's in your best interest to look for competing ETFs that are smaller dollar value that you can replace, because now 100 shares is 7,500. And that's fairly close to the 6,500 that this person is saying that they have available to them. So I like the fact that you're looking for the right ETF to match. You can always do replacements. They move more or less the same, right? A lot of these things are just different issuing bank, has basically the same methodology. So you checked it out, 96% correlation. Yep, the performance is the same. Unfortunately, the volume in the options is very, very limited. So it would not be advisable. But can you buy one in the money call option with Delta 85 to simulate the position? Right up until that last test, I would have said yes. But with the options the way that it is, probably no. The problem there, I mean, you can get into it easy enough if you're wading into it and you're careful not to ever use market prices for options, always use limits and try to go for the midpoint. You don't have to nickel and dime it, but try to get a decent price. The problem is getting out of it. Sometimes people don't look ahead to what happens if I have to get out of this when it's spiking. Sometimes those low option open interest, the market makers don't really provide much liquidity for you to get out of it. And you can take you're already taking a hit because the stock is going against you. And then you kind of take another hit when you're on your way out the door because the option, the bid-ask spread might not really let you get the price you want. So I'd say no. I'd say good try, but trying to simulate stock replacement on large indexes with small accounts is not often doable. So what you would want to do, you might be able to look at some of the individual sector ETFs, like the consumer staples ETF, the the basic materials. Some of the ones that don't move as much, like don't go to the financials, don't go to the energy, but you can go to those, consumer staple type things. Even the utilities ETFs, you could check those out, XLU. And those are very small dollar, well, not very small, but small-ish enough that you could probably do it, and liquid options market. So while of course, the MDY is not the same thing as utilities, it is a net long market position, and you could probably still do that. And correlation-wise, it's going to be very close. On a short-term basis, we typically only hold our trades for a few weeks. Under perfect conditions, maybe a month or so, or maybe 2 months if it's the best period. But correlations are very high with those. So that's what I would be looking for. This one that you pointed out, IWR, I wasn't really familiar with it before, but it just doesn't check all the right boxes. So unfortunately, no. But you've got it right. Your idea is exactly right. That's what you would do. Look for a small dollar stock, high liquid options market, and then buy about 100 to 130 days out in the future. Look for the highest delta you can get with decent option liquidity. If you could get a 0.85 delta, that'd be great. I doubt you would. You'd probably be looking more towards the 0.7-ish range. But higher the better with good options. That's what you're looking for. So you have it all exactly right. It's just that underline is not a good target there. Unfortunately, some of those ETFs, they're just higher dollar. They're $300-$400, sometimes more in some cases, that it does make stock replacement on smaller accounts inefficient. Doesn't mean you can't simulate it with other things and get the correlation right, but it's not ever going to be totally efficient. So that's just unfortunate. But remember, we all started at the same place. We all started on, unless you inherited money or won the lottery, we all started at zero, and we all sort of save money and keep going. And it wasn't that long ago when I was on a small account. So, keep at it, keep saving, keep building. You'll get there. Efficiency is important. So like I said, look for a very stable ETF that is very strongly correlated to the market, and go with that. Start with XLU and expand your search from there. All right. How can one roll the vol trend trade out? Do we just sell another put? I don't know how it works, or it's not a dumb question at all. Rolling is not an obvious thing. So what you would do, there's two options. The first option would be you just simply sell the first one, right? Create a closing order, sell the first one. Wow, 97. It was 92 early market, 1277. VXX is crashing, which is good. Remember, that's good. Look at the tactical vols, nearly $7 now. So this is all good. You could do one of two things. You can close it and then just open the new one. Or depending on what your software looks like and how familiar you are with it, you could do what's called create a rolling order. And what this is going to look like, I'll do it, but I won't execute it. You can see the first one that we have for the 19th. Now we will be buying this back. You see this plus? It means I would be purchasing that back, and then I would be rolling into the next contract. So you can, of course, adjust these. You don't have to roll position for position, strike for strike. What you could do, and what we may end up doing, like I said, the 1250s are looking pretty decent. So you would create, now it would be considered more of a diagonal spread, where I'm buying back the 1350. I'm now selling the March 26th weekly 1250s, and the computer just squares up the difference. So it basically just knows that, look, if you buy this back for 96, you sold it for 16, that's going to be an 80-cent loss. And then you go ahead and you sell the new one. The computer matches all these up for you. And let me just make sure I cancel this. I want to do something stupid. The computer will match it all up for you and do it in a single transaction. But the only thing I would warn you about is it looks a little odd visually, where you're buying one back, you're selling another one, and the premium, especially in that case, you saw minus 48. I would be rolling it out and losing 48 cents, even if that trade goes successfully. So a lot of times people get confused about rolling. And if that's the case, and your software might just look weird, there's nothing wrong with just closing one, opening the other. Trade fees are something these days, but they're obviously significantly reduced compared to what they used to be. So those are your two choices. Close one, open the other immediately within the, a short time window. Don't try to leg in. Don't try to be, the person that I know where the markets are going. I can time it. I'm going to get out of this one. I'm going to wait till the market does this. It recovers. Then I'm going to get a better price. Just sell them within the same 1 or 2 minute period and just forget about the crystal ball type stuff. We don't leg in here. We don't predict markets. We just position based on statistical probabilities. So that's your first choice. If you're comfortable with rolling, you can do that as well. And it just basically saves a few button clicks and potentially some trade fees. That part these days probably doesn't even save trade fees, to be honest, because you will always pay for the options that you trade. There will always be commissions for that. But a lot of brokers do have very close to free trades. So doing 2 transactions or 1 these days may not actually even save you anything. Wow, sorry about that. Hopefully everybody kind of finds their way back to the stream. That can happen from time to time. Inconsistent internet. Let me close as many windows as I can. All right, so what I was saying, what this question is asking is, because I personally sometimes overlay a little bit more aggressive trades with the vol trend, I will typically sell more contracts than the underlying. Yeah, this is a time with, like this week, because I have actually done that, as I will point out. Yeah, it's a little bit worse than what you would want. So my trade, instead of being fully covered by the profit of the other ones, you can see I doubled this position, and I actually have another one here, which is a little position there. So I'm down 7 cents there. Nothing, 187. But this one is a little bit of a concern, right? I'm down the same as everybody else, but I have a double allocation. So this isn't good. Obviously, I have now taken the 20% losing strategy. Everybody else is sort of balancing that against an 80% that's winning strongly. I have to now balance that with the fact that I'm still up money, portfolio is still moving upwards, but I lost money there, right? It's just one of those situations where I have run the numbers. I've been doing this for so many years, basically 8+ years here. These are my personal trades in purple here. I've just run the numbers that it's worth it for me. So January, when the vol trend official strategy was trading here, you can see it made $400 on at the time, I believe the portfolio value was something like 132,000, 140,000. I can't really remember, but it did okay. You can see my trades, I overlaid more, and I made $7,200 when the official strategy only made $400. So this month, right? And then last month, I lost $1,400. And what did the official portfolio made? $600. So this one's made $1,000, right? But I've layered some things here, and I've taken some chances in my private trading that, not really chances, but I've calculated that it's going to work out for me. So I made 5,800 there, made 1,000 there last week. So essentially what it ends up this is a way further ahead teaser, but the vol trend allowed me to not lose money in January, right? I actually made 1.5%. But the flip side, what this person is getting at is, yeah, there can be times when I'm now leveraged into a strategy that's losing badly. So yeah, I'm going to give back some now. And I've basically calculated the difference there. So I know that the only time it ever really bites me is weeks like this, where you absolutely, I am now dipping into some of that profit from the rest of the portfolio. There's no free money in trading. Of course, if you want to have the reason that I personally do it is because I can actually reduce losses in previous months a little bit, right? We're not trying to get too aggressive with it. It's not some, portfolio changing system that I'm doing here. It's just little tweaks here and there that losing months in the total portfolio, vol trend will do better, because how could it lose money if the portfolio lost money? Very strong winning months in the portfolio are less profitable for me. So it just flips the risk reward ratio a little bit. And I personally like the smoothness of it, where, as you know, my brain just functions based on managing risk rather than chasing performance. And so as a risk management tool, what would I rather do? Would I rather minimize drawdowns in bad months or maximize profit in good months? My brain minimizes drawdowns in bad months. It's just the way that I'm wired. When I present it to the community, it will be presented sort of more or less what I just said, is that, look, if you do what I do and you layer a few extra trades, you're switching the risk profile a little bit. It's not changing the long term. It's a little bit more profitable, but it depends on the person. That's why not everybody's going to want to do this. If you're the person who your brain actually likes to see your portfolio grow really fast during good months, you like to participate in those, then the last thing you'd want to do is be selling VXX put options that are sort of chopping the legs out of any really strong profitable months that you could potentially make. For people who look at it sort of the way that my brain looks at the market, and there's no right or wrong here. Some people, if you are more aggressive, that's fine. There's nothing wrong with that. I'm just on the other side, where I like the fact that I lost less money in January and I'm going to make less money this month, maybe significantly less than the broad portfolio. I like that because I like losing less. I don't like making more. I don't know. It's just, you have to know who you are as an investor and how your brain is wired. And this will not be for everybody. The total portfolio is designed for pretty much everybody. I feel like the risk tolerance that I've built within that portfolio, there aren't going to be too many people that fall on either side of that. You'd have to be ultra conservative to look at the total portfolio and say it's not smooth enough for you. I mean, honestly, it's been, as far as drawdowns, and remember there's a 4.6 attached up here, but it would be really difficult for me to imagine a person looking at this and saying it's too wild for their personality. So there's that it's just, I mean, come on. It's probably suitable for almost everybody. And then we do have the leveraged versions if you are wired on that direction. And while there are people who look at even the leveraged total portfolio, they look at that and they think it's not risky enough, there are people that fall in that category. I would say not many. So the broad portfolio is definitely, I would say, for almost everybody in one of the two forms, either basic or leveraged. The vol trend, especially the overlay, it's not suitable for everybody. If you don't want to see your best months get their legs chopped out, then you're not going to want to do this, because that's exactly what's going to happen. You're going to see a month like this or a week like this where, aside from my additional vol trend strategy, everything's going fantastic, right? Profits coming in, your portfolio's going up again. Good to see, since January was a rough one. If you're not the type of person that, if you don't mind seeing that diminished a little bit, great. If you do, not for you. And that's why I've been very, very cautious of presenting this carefully. I want to do a full, really, really good explanation. I'm always the type of person that will focus on the risks and the downsides and be very honest about where this is going to go badly for you, right? I want everybody to know that before I start saying, well, yeah, by the way, it's actually quite profitable and you can make a bunch of money. I will always say that last. In the long string of explanations of a strategy, I will always tell you how much you could potentially earn last. I'll tell you how much you can lose first, where's the risk, who this is for and who it's definitely not for. And then eventually I'll get to the point where I say, by the way, if you do it right, you could make X amount of profit. That's how my brain works. But does the world does the investing world look like that? No. The investing world would present this in the opposite way. They would say, here's how much you can make, and here's how easy it is, and you just do X, Y, Z, and money falls from the sky. And oh, by the way, read the fine print. It can actually have these drawdowns, and bad things can go wrong. But it's not. Don't look over there. Look over here. So I don't know who you are. I don't know how you like to trade or what your risk tolerance is. But the overlay, to get to the heart of your question, yeah, that you've got it exactly right. It can it can cost you. This is not all profit, all bonus, no downside. There's no such thing in the investing world as, hey, I'm trying to find this, but there it is. There are some downsides. Fortunately, the only time it can ever really get in trouble is at the time that you can kind of afford to get in trouble. So I'm okay. I've lost more than the rest of you this week, but still up, just not up nearly as much as all of you. Just the way I like to trade. And I will, believe me, I've been super swamped and busy. I keep saying I'm going to do it. I will introduce it. I promise it's coming. It's just, I am just one person. And just in the last year, I'm sort of topping out at I've always been just a workaholic my whole life. Back when I was golfing, I was born in a city that snows 6 months a year. I started golf way late in my career. I couldn't even break 100 till I was 16 years old. I started when I was 15. And, by age 20, I was a professional. That doesn't happen without just insane hours of practice, right? I wasn't born in San Diego, started when I was 10 years old. I was born in Calgary, Alberta, Canada. I started when I was 16. So I've just been a workhorse my whole life. So when I did my investing career, I've been working, 10 hours a day for 15 years, no vacations. I take my vacation with me, right? I travel the world as I'm working. But just in the last year, I'm really topping out here. And I apologize that it's just the quality of the service is not quite what your longer term viewers are used to. I'm maxing out the hours in the day and there just aren't enough of them. But I will introduce all of this. I promise you, it's coming. If you knew how much work I actually have in a day and how, there's just never enough hours in the day. All right. So given the Fed announcement tomorrow, what can we expect? Well, I have no idea. You could expect any and all outcomes. The Fed meetings, I feel, and this is just a personal thing, and then tomorrow comes and I'm proven wrong, but I feel like they're far less meaningful these days, just given that we are certainly, while anything's possible, we're certainly not expecting any major surprises. I think that would be, there are times when you're really not sure what they're going to do. Then there are other times when you're pretty sure they're not going to want to rock the boat. And I think this is one of those that, yes, it's technically a binary event. Not really. I don't think anything too crazy is going to happen. If I had to put my money on it, if you forced me to make a bet, I would say everything stays exactly as it is. The market will probably react reasonably well to it, and volatility will probably go down further in the week, bleed down. It can't go down, massive amounts for 3 straight days, but that would just be my guess. I think the week's going to finish off with much of what we see now. And I don't think Fed meetings are that important anymore. All right. The threshold strategy has many thresholds, so many spreads to pay. Do you think one can drop that strategy if you want to pay less spread, or would you strongly suggest against this? Interesting. Okay, let's address the first part first. You're absolutely right. Due to the fact that it has different, it has 5 ranges where the ETFs are changing, potential changes of position. What we end up getting is much higher trade frequency. So I'm just going to load up today's email and show you that trade frequency wise, by the way, some people don't know that this is here, but below the trades, there is actually, a few extra charts, and I will continue to add a few more if I feel like they're important. But here's the trade frequency for all of the strategies. It's just directly below the trade signals. And yes, you can see long-term, VB threshold is actually at 5.6 per month on average, and the other ones are sort of in the 3 range. And this is because of that 5 sections rather than 3. It does happen. And this year, given the magnitude of how many times we've been whipsawed, you can see this is updated recently, not today, so there's 16 trades so far this year. That's pretty significant. And so yes, it's one of those things that just simply because there's more thresholds, you can definitely expect to see more trades. The second part of your question, well, first of all, I should say that due to the fact that trade commissions are pretty negligible these days, and the ETFs that we trade are so liquid that everything is basically a penny, there's really no inefficiency to trading 5 sections. The only inefficiency comes during those times where you get whipsawed. You go into one, you go into SPY out of the TLT, and then the TLT did well and SPY got hurt. Then you switch back and the TLT loses money. We've gone through that several times this year. That can happen. But as far as actual inefficiencies, there really isn't any. There's no downside to trading a more active strategy these days. As to whether you can remove it, how can I say this? I don't want to tell anybody what to do. Obviously, I can't legally tell anybody what to do, but I also don't want to influence too much. What I share is, in my opinion, the best way to structure a portfolio. So given the fact that the tactical or the VB threshold is in the email, it's in the portfolio, and it has a 20% allocation, I have deemed through years of trading and many calculations behind the scenes, I feel like it's worth including in the portfolio. If I didn't, I wouldn't include it. Nothing I do is marketing. Nothing I do is for the purpose of introducing things that might convince people to give me money. It is my portfolio, and if it's not sexy and exciting, so be it. It has to be this way. It is my portfolio. So it's in there now, and it is a 20% allocation. It means I feel like it's as important as all of the others. Having said that, there's always the but. Having said that, if you were going to remove one strategy from the portfolio, the first one I would choose is VB threshold. Not because the strategy's bad. It's actually very good long term. It's not done well recently, but that's not the reason I'd remove it. The reason I'd remove it is because VB threshold, in my opinion, is still a volatility strategy, because the majority of the performance is coming from the 20 to 60% range in the barometer. So technically it is a net long short vol strategy, if I view it that way. So if viewed that way, and you already trade tactical volatility or the aggressive vol, then if you are a more conservative investor or you're looking to streamline things a little bit, then you could remove one of the volatility strategies. And the one you, in your case, you might remove because you're already concerned about the high trade frequency, that would be the obvious choice to remove that one. Other people might go the other way. They might remove a volatility strategy, remove tactical vol, keep VB threshold. They're both, fairly correlated. They're both short vol strategies. VB threshold will probably do differently in drawdown periods and recessions because volatility has only long short vol, whereas VB threshold can hold bonds. And so it's different. But if you're going to remove one, that would be the one to remove. In order, you'd remove, I'm not saying do this, but in order, you'd remove VB threshold first, and then you'd make 4 times 25% allocations. After that, you'd probably remove vol trend, because at that point you would be less net long the market. That might start to bleed a little bit. So that would be the next one you'd remove. After that, you'd probably remove defensive rotation. Although I do like that as far as the positive S&P correlation. That'd probably be third. When I launched VTS in January 2012, tactical balanced was 50%. Tactical volatility was 25%. And a third strategy called iron condors, basically VTS options, only using iron condors, was 25%. That was the original portfolio all the way back in 2012. And it has progressed to the point now that you see today. It hasn't changed much, but there have been a few strategies here and there. Some have left. Well, 2 have left. I can be specific here. 2 have left. 2 have arrived. So that's where it was at. But those 2 strategies are the originals, so you could sort of reduce down to just those 2 at the very end. And then, of course, double balanced or triple the balanced for every one allocation in the volatility. Don't equal amount those. But that's what I would say. Obviously, if you can do it, since you're following somebody's work online, right? Doesn't matter if it's me or somebody else. If you're following somebody else's work, you should probably try to follow somebody else's work, right? Follow the work, because you don't know what's going on behind the scenes. You wouldn't want to be too presumptuous that you know more than me. You might be smarter investor than me. That's certainly possible. I'm not going to say that that's not possible, but you're not smarter with respect to VTS strategies than I am. I'm the only one that knows how these work. So it would be fairly presumptuous for other people to follow my work and then start picking and choosing, well, I don't like that and I don't like that and I want to change that. And you can change a few things, but once you start deviating too far from the person who created the portfolio in the first place, then you would be opening yourself up to a few risks there. So I can't directly tell you what to do. No personalized investment advice, but just as a general rule of thumb, when you're following somebody's work and it's not 100% transparent, like I don't share the metrics that create those strategies, it would be dangerous for you to make too many major changes. Hopefully that made sense. In a roundabout, ethical, compliance way, I can't exactly tell you. All right, last Friday, I followed the closing of the VXX. The settlement price is market closing at 4 p.m. Yes, that has been changed. Settlements are now 4 p.m. But the options of the expiration still trading for 15 more minutes. Options, I mean, they're all different. Top of my head, I don't really know. Options can trade substantially longer hours and off hours and whatnot, and different indexes and tickers and volatility things are available. So it's always different. But remember, options aren't the ETF. You was short the 14. I think you're referring to the fact that I had the short 14 put open last week. That was done. I think it closed. Mine officially, this is all just going by memory because when I'm updating my spreadsheets, I think it closed at 13.96, something like that. And I believe I got 8 or 9 cents for the contract. Again, these numbers are blurring together, but I think I got 9 cents. It was a slightly profitable trade. That's all I really remember. But as far as the options go, I've explained this a few times before that we typically won't take assignment. So because you're taking on weekend risk if you hold VXX on the long side. So this question that you're asking, while practically it might be useful to know, settlements at 4 and options run a little longer. For us, it won't really matter because we're not actually going to let these run. There could be times when we do. I'm not going to close the book on that. But typically a re-roll during market hours on Friday will be what we default to. And it doesn't even have to be Friday. It could be any day of the week. We can always trade. We don't have to be, victims to the 5-day cycle. We don't, that's just, the market doesn't know it's Friday or Tuesday. It doesn't care. So we shouldn't either. We shouldn't just because weekly options expire on Friday, now all of a sudden we have to trade once a week every Friday. It doesn't work that way. I trade when I want to trade. Sometimes I roll early, sometimes I roll on Friday, but this probably won't come up. You won't get in a situation where too often where you'll have to know that you're going to be tracking your trade 15 minutes after markets close and all that stuff. All right. There's a second part here. If the options market closes 15 minutes later, could we use that time to sell the covered call knowing that we have been assigned without waiting for Monday? No, because assignment happens in options, not the VXX settlement. So you can see the VXX settle at 4, but your option's still open. So you don't know if you sell a covered call thinking that I know I'm going to be assigned, you don't know you're going to be assigned yet because the options are still trading. That's why you can't. If you do what you're saying, it would require a margin account because you are preemptively selling a covered call, assuming you're going to get assigned, knowing that it's possible that in the last 5 minutes, it changes radically again. And then, turns out I wasn't going to get assigned. Well, now I'm going through the weekend with a short VXX call, right? you're a naked short VXX call. If you do get assigned and you don't sell the call, well, now I'm going through the weekend with a long VXX share. So that's why typically I will just say, while you might lose a few pennies on the rebalancing, you'll lose, Friday afternoon theta maybe. It is best to just define your risk. And if you do either one of those two, take assignment without selling a covered call, or sell a covered call without fully knowing that you're going to get assigned, because you can't. If you can sell a covered call, you don't know if you're assigned yet. You can't have one without the other, right? The market's still open. So define your risk. Make it real easy. Roll the trade. Just cut out that whole risk middleman and just roll the trade. You might lose a couple pennies, but long run, it doesn't matter. Safety is, in my brain, of course, safety is everything. Yeah, this is true. XLU is basically identical to VPU. The only reason that I said XLU and not VPU is the price is way lower and the options are more liquid. So if you are doing, if you're trying to do stock replacement, XLU is one of those targets that you want to sort of keep in mind. And like I said, the consumer staples ETF, the basic materials ETF, those move slower. The option premiums are a little bit lower, but those work just fine as well. For simulating long index equity positions. Okay, let me run the numbers here. If I buy a call with delta 0.5, but I don't reserve the money out, I consider it as a bet of itself full committed. Basically, I'm adding leverage. Am I right? If what you mean is, let's say you have $10,000, and instead of reserving the capital required, meaning you calculate what the current price is, 100 shares is one contract, the way that we do it. If you're saying that you have 10 grand and you just buy $10,000 worth of options at 0.5 delta, you are a 2 times leverage position at that point, because the options are going to be way cheaper, so you can buy way more of them. And well, you wouldn't necessarily be 2 times. I shouldn't have said that. It'll be different each trade, but roughly, yes, you would be getting into that range. Our trade right now is a 0.4 multiplier, so you'd be, not quite 2 times. But yes, you can always buy far more options than the actual capital it requires. So you have to be very careful with this. If you don't reserve the capital and you just burn through all your available capital with options contracts only, like for example, if what you're saying is, instead of me buying 23 contracts here, because it's only $5.75 and it was trading at $14.77 when I opened it, instead of doing that, I just bought a whole bunch of $5.75 options, I would be very leveraged at that point. I would be more than 2 times leveraged. That's a 0.4 multiplier. I'd be significantly leveraged. At that point, all bets are off. Now the correlations with my portfolio they no longer apply. Now you're going to be in a position that I never accounted for, that I never planned for. There's no offsetting position for that amount of leverage. You are just assuming that you know more than the market, right? You're assuming you know which direction it's going. Don't do that. Don't do that when you're following me. You can do whatever you want with your own money, but when you're following my strategies, again, it gets back to the whole, you don't fully know what you're doing because it's mine and I didn't share everything, right? You could understand it if I explained it all. I'm not saying that people are, ignorant and they're not good investors. I'm saying you don't know my spreadsheet. You don't have my numbers. So for people to go changing things and saying, well, I'm not actually going to reserve the capital, I'm just going to go full boat on that trade. Well, now you've gone rogue with a massive leverage position. And obviously I can't be responsible for how that's going to go. It could go extremely well. If we still get volatility decline and you're 2.5 times leveraged, well, guess who just made a whole bunch of money, right? But hopefully you've been listening and following me long enough that your brain immediately goes to the thing that, what if the opposite's true? That you always want to remember that it is a double-edged sword. The first question you have to ask yourself is, what if this goes badly? Don't ask yourself, what if this goes well? What if I'm right? Don't ever ask yourself, what if you're right? You're going to be right just by default, just by statistical dumb luck. If you take enough trades, a lot of them are going to be winners. Don't ask, what's the best case scenario? Always ask, how could this go wrong? what am I on the hook for if this goes terribly wrong? If I'm just dead wrong, those are the right questions. So obviously, not reserving the full capital and just burning through your capital with 0.5 delta options, you better have a good crystal ball and you better have a lot of luck on your side, because that's a very leveraged position. Okay, if I have not misunderstood you with the vol trend overlay, you managed to fully compensate for the losses of the month of January, correct? Yes, I personally made 1.5% in January, given the portfolio lost 5%. And like I said, this is not for everybody, and this is a very partial introduction, but you can see it here. Oh, I get it. Yeah, sorry. That confused me a little bit. This isn't exactly correct because this portfolio is a 2021, and about 1% of the losses, this 3.57 should actually say 4.52, I believe. The only reason it doesn't is because I entered the trades for this 2021 portfolio on January 4th, but the portfolio itself was already in trades going through the new year. And that first day on January 4th of 2021, that was a losing day as well with about a 1% loss. So I ended up losing 5,086 on this portfolio that started at 142,000 on day one. I lost 5,485. Or no, official vol trend made a bit. I lost 5,000 and my overlay made 7,200. So I ended up earning a profit of 1.54. The next month, the portfolio made 1,660, but I lost money, right? So I flipped that. The portfolio itself was up money. I lost money, but then it broke even. So technically this portfolio is up, basically, I don't know, what is it, 2%, 1.7%. This year's been kind of flat for VTS, so it's not crushing it or anything, but up 1.7 due to my slightly more aggressive overlays that I like to do. But as you saw, February cost me. And right now this week, it's costing me. So this is not free. This is not like all upside, no downside. It's just flipping that risk reward ratio a little bit. But yes, just to confirm to answer your question directly, yes, that's what happened. What do you think will happen in the U.S. 10-year Treasury yield continue to rise? How will it impact our portfolio? If the 10-year continues to rise, which I think there's certainly a ceiling on that because it would bankrupt Western countries if it continued too far. So, given the fact that the government and the Fed and all the powers that be, they are the puppet masters, holding the markets together. So I don't think they're going to allow it to do anything devastating. The one thought that you could have is it could be catastrophic, right? It could, if it just continues to rise and we get back to sort of a normal interest rate level, if we ever saw 5 to 6% rates again, it would be devastating to the economy. But of course, in a practical sense, is that ever going to happen? Why would somebody basically, cut off their own leg, right? And it would be worse than cutting off your own leg. It'd probably be cutting off your own head, to be honest. So it's not going to continue to rise. Interest rates are probably going to fluctuate within a band of about 2% or so for the long-term extendable future. They might fluctuate up and down a little bit, but I think it's nearly impossible to imagine that anybody would allow the economy to crash. It's exactly what would happen if this continued. So where's the, I should do a screen share. I mean, we've witnessed this year that just the sheer ugliness of the TLT, right? Come on, internet. Yeah, like look at this. This is certainly this is obviously the COVID mess. Since COVID, not so great for the old TLT, for treasuries. Remember, there's that inverse correlation between rates are obviously ticking upward to make this go downward. Not so hot for the old treasury market. And unfortunately, one of our safety positions is treasuries. So we've felt a little bit of that. But This is not going to be a long-term thing because it can't be a long-term thing. There's just no way the economy could sustain itself if this gets too out of control. So I'm not a conspiracy theorist. I am evidence-based always, but at some point you also have to just remove all data from the equation and just say, what are the elite wealthy people likely to do? Probably protect their own capital, right? That's a pretty good assumption that the government will be protecting their pension funds. The Fed will be protecting their bottom lines and what personally benefits them. You want to go far enough and call them the Illuminati and they're pulling strings and the Rothschilds. And I mean, how far do you want to go? Or just ask yourself the question, what do rich people in power tend to do? Protect their wealth. So will rates get out of control if you just simply ask, why would rich people crash their own equity? Because obviously they're wealthy because of real estate and stocks. Are they likely to just chop it out and just have the bottom fall out? I don't think so. So it's just not realistic. In a perfect free market economy, rates would not be where they are anyway. We all know that this is being manipulated artificially for decades, right? So if we allow too much data to enter this question, it can be a problem because the right answer is rates should go up consistently for a very long time until they hit 6 or 7%. That's how the world sort of should balance itself out. That's not going to happen. There's no way that's going to happen. I would put my money, I'll bet my money that those people are going to protect their money. That's what I'm betting. So no, rates are going to stabilize. And the Fed's not going to do anything crazy. They're not going to come out and say, some shock move. It's not going to be, back in the 80s when they just do a shock interest rate rise. They're not going to do things like that. That would be directly removing money from their bank accounts. I don't see them doing that. Them, whoever them is in your mind. All right, we're winding down here. I don't know how long we've been going because the stream ended and now it says 36 minutes. I don't know how long the first before we cut out was, but I should probably go for a run soon. I was running all morning, unpacking, packing, moving. Now I want to go for a run for myself, casually enjoy my morning run. All right. I was just curious, but I won't drop the VB threshold. Just curious because I have to do stock replacement. Okay, that's different. And pay spreads along the way. Your answer was great, as per usual. Thanks. Thank you for all the questions. You can always ask curiosities. They don't even have to be well-formed. You can bounce ideas, right? A lot of things I say are not fully formed thoughts either. So hopefully I got the answer there. The part that you said about stock replacement does make the equation different, right? Because now you are dealing with, now you're going to have to pay. You can't buy and sell options. I shouldn't say you can't, but you'd have to go pretty low down on the rung of quality of broker before you get to option trading fees that are substantially low. Most quality brokers these days are still charging for their options trades, and rightfully so. Remember, you get what you pay for, and surely you can find brokers that will allow you to enter and exit trades with seemingly cheap prices. There's nothing cheap. There's always something, right? Robinhood makes money. They just don't make money in the traditional way. And so with reputable brokers, options are always going to cost money. And if you are doing stock replacement, 16 trades this year on the VB threshold is going to be significantly more expensive than doing 4 trades on the tactical balanced. It's now an issue. Not an issue, but it's something to keep in mind. You want to track your trades, check if you're being efficient with your entries and exits. What I would suggest, I've mentioned many times, I record a lot of detail in things, but you might want to record the price. For example, it's just a data point that you might want to know is, like, I track this one called the open mark. I just want to know what it was trading at the moment that I opened it, right? Because then I can go back in the future and I can see, well, I sold the 1350 strike when it was trading at 1471. What price did I get? This is VXX, so it's super liquid. But if you're doing stock replacement, you might want to add another column here and add, okay, the price based on how efficient was your fill price. How close to that mid price did you get on your actual executed trade? You might want to keep track of that for a few months and go back and review it. And if you think, wow, I'm losing 5 or 10 cents every time I do one of these trades, then you might want to seriously reconsider not trading that strategy. Because while it is long-term profitable, you have to remember that fees can add up, right? All fees you pay me, they add up. You want to make sure that you're not paying too much for your monthly subscriptions. You want to make sure you're not paying too much for your commissions. How are you going to know that unless you have an accurate, detailed spreadsheet? You're just going to be taking guesses. And I don't guess with anything in my work. I don't suggest you guess in yours. Write it down, the actual price of the ETF, the moment you hit execute, and then check how close to that you got on the bid-ask spread of your options. And let's review in a couple months. Either send me an email or let's do it in a live stream. Let's review your results and we can see how efficient it is. Of course, it's going to be different based on the size of your account, but yeah, data is your friend. The only way you will actually truly be able to answer that question is compiling enough data that you can actually answer the question. So yeah, I didn't know it was on a stock replacement. That adds a secondary layer of inefficiency. Trading ETFs is super efficient these days. Trading options is much better than it was 5 or 10 years ago, but still not totally free. It costs you something. I think what do I pay? For IB, it's different because they base on whether you're adding liquidity to the market or not. But I would say I average about 35 cents per contract. And at TOS, I think I'm at about 50 cents or maybe even 60 cents. 60 cents. So it's not free. And that's per contract, right? If you open 20 contracts, it's several dollars. It can cost you money long term. Okay, we get these every day, so I'm ready for you. What do you got? TLT's performance. Have you considered swapping out TLT with some other asset class? I've considered it. I've calculated it. I've run all the numbers for all competing things that I consider still competing and safety. TLT is still mathematically the best, and my brain can't get past the numbers. So as I did a full, I think like a 20-minute spiel on this with charts and evidence that even though it feels like we're losing money on TLT, they're still profitable. Even though it feels like IEF has been costing us, we're getting whipsawed in and out, it's still mathematically very profitable to hold the IEF. Numbers wise, it's still the position that I do. And remember, my portfolio is no more than that. It is just my portfolio. I still hold TLT for safety. However, the little caveat here is the case to be made for holding something else or just holding cash instead of bonds is much stronger now than it was a few years ago. So in that respect, I default to TLT and IEF. The second choice I would say is just hold cash because it's actually a safety. We don't actually have to make money. Most of the performance of what I do comes from periods like this week, like the previous couple of weeks, stability or full-on recession. That would be good for us as well. If we get, it would be I shouldn't have said that. Recessions are awful globally. I mean, a lot of people get hurt by recession. So I'm not saying that I'm hoping for a recession. I don't want to end up on a sort of a YouTube gotcha. Somebody takes out of context that I'm cheering for a recession. But performance-wise, let's just say I'm not worried about a recession. But most of the performance comes from those strong trends, either strong uptrend or strong downtrend. So if we're in safety, we're in safety. You can just hold cash if you don't like TLT. And like I said, lately, there's plenty of reasons not to like TLT. Mathematically, it's still the best position to take. Read between the lines there. I can't directly tell you what to do, but bonds or cash, they're neck and neck right now. That is one of the reasons why I went away from leveraged bonds. We don't hold the UST anymore because the case is just weaker these days. So now we hold the IEF on its own. This is the last question, at least in my stream. You know what I should do? No, I'll do that later. I don't want to make you watch me. see if there's more questions. So this is the last one. It's not really a question, is it? Thanks a lot for your time. Excited for Friday, probably because of the rebalance of the vol trend. Let's see what will be the new setup for the option strategy. It may not be Friday. So if we look at it now, if I just am sort of thinking out loud here, we've seen some massive crush. So I know no matter what, let me make sure it's on screen share. I know no matter what, whatever I do now, I can actually start to get progressively more aggressive with that specific strategy, because as long as the market continues to do what it does, none of these are going to change. This SSO is, I can actually do that live if you want. I don't know if people care. I'll do that in a minute. I'll just execute that. But these aren't going to change. These are going to be strong. And of course, the tactical volatility strategy, that's not going to change either. We're going to be in all of those. And so if next week looks like this week, well, it's going to be all good. Personally, I'm going to feel, I'm going to take a little bit more damage because I'm doubling up those contracts. But just thinking out loud, what would I want to do? So I could get out of this at about 86, or I could wait and it would, as long as VXX flatlines for the rest of the week, then vol trend's actually in a perfect sweet spot. Not perfect, but actually a pretty good place. If this goes down to 12, which of course it technically could, it'd surprise me, but it could go down to 12, then we would be looking to get in quite aggressive on the next week. As of right now, I kind of like those 12s. I'm the type of trade, because remember, I know vol trend is a slightly offset to the rest of the portfolio. So I don't chase any numbers. I don't lock myself into any cost basis. I don't try to recover previous losses. This is called anchoring bias in the investing world, where you see a cost basis or you see a profit line and you do things in order to recover to that level. I don't do that. I don't view it that way. So the 80 cents that I'm going to lose, or whatever it is, if it closes at $12.95, my break even is $13.33. So I'm going to lose 38 cents. If it breaks right now, I'm going to lose 38 cents. That's gone, and gone forever. I'm not going to try to go, well, the 42, that gets me 38 plus 4 cents, and I'd actually have made a profit. I don't do that. The 38 cents or whatever it is, it's gone, right? That's money lost. So now I'm just trying to say, let's just say I'm a brand new trader this week with no history whatsoever. What contract would I like? I like those 12s. So that's probably what I would be considering doing. I would be either, like I answered the previous one, I would be either selling this for the loss and then buying this for the loss and then selling that one, the 12s, pick up 20 cents and see what happens next week. Break even at 11.80. Imagine where the portfolio is going to be profit-wise if the VXX is at 11.80 by next Friday. It's going to be pretty solid, right? That's going to be a very profitable week. So yeah, just spitballing here. This isn't the official thing, but I'm liking the 12s right now. But that thing I said about not anchoring to cost basis, that is key, certainly for all investing, but it's very important for a strategy like the vol trend. It's very important to not try to recover the loss from this week. That money's gone. Don't try to sell more premium next week to make up for the premium you lost this week. Next week is a 100% independent trade, having nothing to do with the losses we just took. That is very important for all investing. Always remember that. It does not matter, and the market doesn't care what your cost basis was. Doesn't care that I lost 4.6% in January. So now I'm going to try to ramp things up a bit and try to make that money back. No, it's gone. It's just, that's it. It happened. The best thing I can do is just get my money today into the best trades that make money for me today. So the reason I said all of this is there will be people tempted by that 12.50 contract to maybe even in the money. There's nothing wrong with selling in the money. Selling a 13 for 70 cents, that's a break even of 12.30. That's not bad. That's way below here. So sometimes I do that actually. You might actually see me sometimes sell some significantly in the money contract. In fact, if the VXX is strong down next week, if it gets to the 11s next week, you might see me hit hard on a very in the money spread. What would be the benefit there? Well, I could get over $1. My break-even point would still be fairly low. But if the VXX reverses and has a spike, just for a little spike, just 1 week, that's all it takes, you can actually get paid a full $1. So there are times occasionally when I will bite off a whole lot of these in the monies. But the point is, don't ever do it because you just lost 80 cents last week. That's not what I'm doing. Those 12s are pretty good right now. The 1250s aren't terrible either. So that's kind of what I'm looking for. So just to finish off this stream, still got a few people going. I'll just go ahead and execute this. Sometimes people like to watch trades actually go through. I'm sure you guys all know how to do this, but here's what I do. I would, of course, wait till market close because I always like to, within 5 or 10 minutes of market close. But I would just close this. And since we're talking about the SSO, right now it is 1 penny wide. So I don't really care about the prices that I'm getting. I basically just hit, click, click, send. And then because this strategy is 20% of my portfolio in this practice account, remember my long-term portfolio is at Interactive Brokers. This is just a practice account for the live streams. But all you do, and I'm sure you know this, I'm just speaking out loud, but you just take the net liquidation value at the moment, 177,878 divided by 5, because the VB threshold is 20% of the portfolio. That would be, I did it on my phone, but I might as well do it here. 872 times, there we go. That's the amount that I'm working with. So I will just go over to the SVXY. It's trading at 44.36. I'll just go divided by 44.36. And I want to trade, always round down. This is very close, but I'll round down because I'm very math oriented. Even if it's 0.01, I'll still round down. So 801. I just need to go ahead and buy 801 contracts of SVXY. And the only thing I really check, because again, the bid ask is so close that there's never any inefficiency here. The only thing that I will check is to make sure that it is only 1/5 of the net liquidation. Sometimes you fat finger it and you put 8,000 shares or something and you'll be able to see it here. So I just double check. Yep, 35,500. That's about what it was supposed to be. And I go ahead and execute it. And again, these are super liquid stuff. Now that we're not using UST or UBT anymore, I don't think we trade anything that isn't a penny wide. So there we go. Now I'm good to go. And this right now is as aggressive as my portfolio ever gets allocated. I am, this one anyway. Remember, again, my long-term portfolio is elsewhere. I don't want to switch brokers just for the live streams. So I funded this one recently. But this is the long-term portfolio. But as far as the leveraged version that is in this live stream account, this is as aggressive as we get. So Voltrend can now basically, what can't you do with it now that the portfolio has 80% of it fully leveraged, right? It's all out net long the market. Now, like I said, I could actually consider selling a nice beefy in the money VXX put option and just knowing that I'm going to be bringing in a lot of premium. It's going to drop the break-even price way down close to 12 anyway. But if the VXX goes up next week, even a little bit, I'm not saying it has to volatility spike, just stock market's down 1%, VXX is flat, right? Good enough. You can collect your full money, or you can collect a very good chunk of that money. And so while it is a penny strategy, I always talk about it as if it's a penny strategy. We're looking for, say on average, 10 cents a week, 40 weeks a year, something like that. And that's, of course, given that the VXX is priced around where it is now. But that's what we're looking for. And that doesn't mean I have to actually sell a 10-cent contract. I can sell a $1.50 contract way in the money, and still, the way that it breaks down, that's still technically a 10-cent trade. It's just that if I happen to get lucky on a single week and it spikes, to get back to the previous question where I think it was Andreas asked, or no, yeah, this Andres, not this Andreas, this Andres. Did I fully? Well, yeah, because one of those weeks I did do one of those. I did do like a real close to the money trade. And what happened? Well, the volatility spiked. So I'm going to get all that premium, right? And that large beefy premium is going to offset the little stuff that or the big stuff that I lost on the other side. So that's how it happened. It didn't happen because I had 25 winning trades in a row. It just happened because I was so long the market. Remember in January, it was going very well for us. I was actually fully allocated anyway, so I got quite aggressive with those and the market crashed on us. Well, good for me because I was quite loaded up there with the VXX puts, and that's how it can happen. So I'd say those are probably the three possibilities. I'll either sell the 12s, the 1250s, or just to show you how it's done, and maybe sell the 13s of the 1350s. Mathematically, it's kind of the same thing. It's just it's just moving risk around. It's not eliminating it or increasing it. It's just moving it around. That's what I view the vol trend strategy as. If you take it on layers like I do, you're just moving the risk from one place to another. I'll have to make sure. Yeah, it's going to be interesting how I explain it. And of course, I'll do as many live streams as you need to understand it. I might even do for the first few weeks, just tell everybody ahead of time, this is a vol trend only stream. One thing that I will mention, and of course only 30 of you will hear me say this because there's 30 people watching right now, but I got a couple of emails from people saying, don't forget that we've been supporting your work and, don't reprice everything. Is there going to be grandfathered in pricing? I just want everybody to know because I haven't had time to introduce it and explain it, but 0 people in the VTS community will have their prices increased. When I said that I need a commitment before introducing stuff that is technically, in a roundabout way might sound riskier, I didn't mean a financial commitment. Nobody will be paying any extra money for any of this. Even if you go the full vol trend overlay, I'm not adding any money to any of this. I didn't mean a financial commitment. Hopefully people know me better than that. They know that I don't nickel and dime people. My service, although I can, it's maybe a little arrogant, but I can say it's probably more substantial than most, let's say. It's still the cheapest around. My prices are still far cheaper than 99% of other services out there. And I feel like it's better than 99% of services. I could jack up my prices. I've had people do that. Like, why are you... when I was trying to solve my email issues, believe me, I had dozens of emails from people saying, here's an easy fix. Just charge $300 a month. You'll have 1/3 as many subscribers, email problem solved, but your income won't change, right? Obviously, I'm not going to do that. I don't nickel and dime people. I would rather have 10,000 subscribers paying a small amount than, jack up the prices so much that only large account holders can even follow me. It just doesn't make sense. So rest assured, you will not be paying more money. You will get all of this. Everything you currently see, you will see plus more, and there will not be any price increases. So I don't exactly know how I'm going to introduce all of this, but I will. And I think everybody will be fine. Everybody will be okay with it. I don't think there's going to be anybody that feels ripped off because nothing's going to change. You're going to get everything you always had, plus a little bit more. So that's it. Let's leave it there. Let me go for my run. And I got to figure out why the internet has cut out on me in several of these streams. That's quite annoying because I want to do a public stream tomorrow. Either tomorrow or Thursday. I want to do a full stream dedicated to those new volatility ETPs that have launched. There's a new 1x and a 2x sort of old XIV and old TVIX replacements. They have actually been approved. They don't launch yet. That might be a distance away yet, but they have finally been approved. So I don't want to do public streams if it's going to cut out though. everybody in the private, they all know to just sort of click again and get right back on, but the public people might not know that. So anyway, thank you all. See you in the next stream. I think we scheduled it for Friday, didn't we? So see you Friday. Thank you so much for watching the video. So don't forget to subscribe to the channel and go check out my website right here. There's tons of articles and videos on there, as well as a free trial to join the VTS investing community. What have you got to lose? Come see how I personally navigate these unruly markets. See you next time.